And 3, 2, 1.
All right.
Hey, Jerry, what's up?
It is January. How about that?
Man, I love it. I'm ready to get into 2023.
I know. Me too.
I want to see if there's a big fall, there's a big rise.
Big rise. You know, it hasn't happened yet. And I think that's like the quote. I've talked to a bunch of people this week, and it just more kind of reinforces the methodology / the way we look at things here that's different from the way everybody else does.
Not really. Everybody. We follow a lot of people that think like us.
Yeah, I mean, the difference is like, and we're going to talk about Larry Williams, who does this forecast every year, and I pulled out some of the highlights from his forecast, but I think it's the way our brain works. We want to see into the future and make decisions today based on what we think is going to happen in the future.
Right. We all want a crystal ball. Everybody
right.
does. I mean, I do too. It'd be great.
Right.
You know, we just don't have it.
Right. No. And the thing is, the more crystal balls you start looking at, right, they conflict. And so if this really smart person, you know, is right, then the other really smart person has to be wrong. So how do you reconcile those two things?
Right. And you know, I think that's a very interesting point, because this is what I always tell people about the mainstream media, financial media, right? I'm not talking about CNN and Fox. I'm more talking about MSNBC, Bloomberg, Yahoo Finance, you know, on and on and on. They have to run 24 hours a day, and they can't really have massively dissenting opinions. Yeah. So they all kind of move into the same rhythm and never really tell you anything, right? Yeah. Yeah. They get other people to come on and say things, take positions. Yeah. But even then you'll see, like we know to look, and they're like, yeah, you're taking the middle road. That's not what you really believe or what you really think. But you know, if you say that, it's going to put you in the corner anyway. So we try not to listen to all that. I mean, we literally just turned off Bloomberg to put this on the thing. But I think it all comes down to what we talk about, and the reason we do the show, the reason we have this website is education. Yeah. I think if you're an educated investor, you're able to filter through all of that. You know, and if you hear a very smart person say one thing and a very smart person say another one, you understand that they both probably don't. Well, maybe they do, but you know that there's probably somewhere in between, right? There's some value in both, and you really just gotta let it play out. Yeah.
So the letting it play out is the thing. So for me, like, I will follow Larry Williams that we're going to talk about here. He's one of the few forecasters that is forecasting a bullish 2023, particularly in the short term. We talked about how everybody seems to think that the first half of the year.
Sorry, I was trying to get the bull in there. It's bullish. Come on.
The first half of the year is supposed to be really bad, right? Everybody's saying we're going to have a recession, and the first half of the year is going to be bad, and the second half of the year is going to be really good. Well, Larry Williams, he basically says that October was the low. And we're in the beginning of a new bull market, new relatively longer term bull market. So his forecast is much different than the consensus forecast in financial news media. And they're both, he's a phenomenal investor, so he might be right. And there are other versions. There's not just him versus the other guys. There are other people that think that we're not going to have a recession. We're going to have stagflation, which, you know, this is really loud. What have you just did?
I didn't change anything.
So if we have stagflation, it's possible that that's good. The rates go up and employment stays strong. So you have stagflation, right? And that is actually what's happening literally today. The jobs report comes out,
right? And
people aren't getting laid off.
Jobs are strong.
So jobs are strong, right? There's like 1.7 openings for every person that says they need a job. The employment rate went down to 3.5 from 3.7. I mean, and somehow the market isn't tanking today. I have no idea. I mean, you know.
Yeah. The job report stuff, I have a hard time investing a lot of weight into it, because I think of ourselves, you know, Jerry and I both have had at least together, two separate businesses, one that had quite a few employees, and then we've both done things separately or whatever. And like right now, like if Jerry and I might be in a position where we need a little help doing a couple things, right? But we don't, but we're like, we still want to kind of keep it lean and whatever, so is it because a lot of small to medium-sized businesses are just kind of hesitant to bring on people right now? Because they might want to be remote. No, I want you in the office. Like there's a whole lot of factors in there that tells me the job market report is done based on a 1970s and 80s kind of structure. Yeah. Like that's really what it is. Like, how many mechanics and social workers and police, like it's normal jobs, which jobs are just different now. Right. So anyway, I just wanted to kind of throw that out that, that's why when I see kind of that come out and I'm like, yeah, but is it strong? Like, I don't know if it is. I don't know if I can put all the weight in that report like the media is and the regular, analysts. I don't know.
No, well, that's what the Fed is trying to do right now, right? Because if jobs are strong, and the Fed is trying to bring down inflation, if everybody has plenty of money, then the price of everything keeps going up. So the correlation between unemployment and disinflation. So inflation will come down as people, get laid off. Mm-hmm. So it's not good for the economy on the one hand, but it's what the Fed wants on the other hand.
Right.
So that's why, this idea of bad is good. When the news comes out that you think would be good, right? More people are getting employed.
You're like, well, why?
That's not good because the Fed's going to keep raising rates now, right. and that's going to, it pushes up prices for everything, and ultimately it forces unemployment, which is what's going to have to happen.
It's weird to want unemployment, isn't it? Like it's just a hard thing to wrap your head around. We needed just enough misery to bring the prices back down.
Yeah, they need people to demand to slow down. Yeah. I mean, if you're making as much as you were making last year, you're not going out to the restaurant any less. You're not, you're still buying a new car. You're still doing what you're doing.
Mm-hmm. They want to.
They need that demand to slow down, and the only way they can do it is take money out of people's pockets.
It's a crazy system.
All right, so.
Hey, one thing before we get started, I think it was probably me that misspoke or misexplained. Is that a word? Explained incorrectly. So I don't know if it was on the show or the member call. Probably was both because we did them back to back. But it was about last week or the week before where we talked about the new performance metrics that we have on the website. So we had talked about how we hired, a financial firm. Basically a bunch of CFA, people. So we left it up to them to figure out our performance, right? We didn't have any input. We basically, they get the data, they take when we make our moves, base that on when the TSP closing prices are. They do simple calculations to come up with rate of return, risk-adjusted rate of return, and Sharpe ratio. That's what we ask for. All the things that are on our website are kind of the industry standard of what, by the way, we have absolutely no obligation to do that because we're not financial advisors. Right. We're doing this as an education piece, like as a newsletter, all that stuff. So we have absolutely no obligation to do it. But we've always kind of felt that part of education is transparency, right? If you don't know how we're doing it, if we keep that part, away, then you're not really getting the full education. Right. So we've worked hard to get to that level, to that ability to do that. And so we hired a firm to do that. Then we took that, hired another third-party firm, had absolutely no connection, to audit it and confirm it. And at the end of the day, everything that's on that performance page is correct, right? The calculations are correct and the data is correct. And so what I said was, hey, feel free to go, do the calculations yourself. Right. The data's there. And so that got misinterpreted as we were going to give out all the spreadsheets and stuff that they did, the calculations and all. That's their proprietary software, whatever they do. Like I don't go to Fidelity and ask them how they calculated it. Right. I have to accept at some point that they're beholden to do it correctly, right? And you can test the calculations if you are a financial analyst or you know how to do it. And what I meant by that is you can go to tsp.gov, download a year's worth of closing prices for all the funds. You can go to our website and you won't be able to download it, but it's all on a table. You can copy and paste every move we made for the last at least the last year. Eventually, I'll have probably the last 3 years up there, but I'm having to slowly. There's other priorities. I'm trying to get a new app built. Yeah. But anyway, the point is, even if you wanted to do the last year, maybe you say to yourself, "There's no way you guys were almost 8%, and the S&P, C fund was down 20%." Okay, if you don't believe us, we give you the data, right? You have it from the TSP site. If you don't know where to find it, I'm going to try to put a link on our site that you can go directly to it. You can literally download it as a spreadsheet. You could take hours and put it in a spreadsheet. And if you know how to calculate risk-adjusted rate of return, by the way, if you're wondering what we used as the safe fund or what, that's the G fund, right? There's one you have to have like
on the Sharpe ratio,
right? On the Sharpe ratio. I'm sorry, yeah, like a risk-free fund. Right. Normally, that's going to be a money market account. For us, it was the G fund. That's really the only part that you may be thinking like, well, what did they use? We use the G fund, obviously. So, hey, if you want to dispute those numbers, go for it. But we have had probably 10 different people reach out to us and say, oh, this looks off, that looks off. Hey, guys, gals, like, I'm sorry if you think that. But these folks who are literally do this for a living, right? This wasn't some mom and pop shop. They did it. And we have to put, and it's been audited again. So, and to be fully transparent, we had one more business analyst take a look at it just for the heck of it. So 3 different sets of companies have looked at this, not us. It is what it is. So if you want, when I said, hey, if you guys want to figure it out yourself, I didn't mean we're going to like give you some spreadsheet or something. Yeah. We don't have. That's not what
I'm not sure we could if we wanted to give it out.
It's theirs. Yeah. Like we hired them to do it. We're not giving out their proprietary whatever the heck it is. I mean, and if the feedback we got from some person was like, well, it's not that hard. It's this calculation. Okay, well then do it.
Right.
Like you have the data. You have our moves.
Yep.
Except for the latest one. And you have all the TSP closing prices. If you want to go figure it out, go for it. And at least 3 times now, someone has come, oh, this. And you know what? When we said, no, you're looking at the wrong thing, they're like, oh, sorry. So look, I know we're probably speaking to like 40 people right now, and I apologize for everyone else that's having to sit through this, but I feel like I kind of misrepresented it last time. Like I may have said it wrong, but I just wanted to be clear.
Yeah.
You have the data available to you. You have our moves. And you have the TSP closing prices. Go figure it out if you want. Here's the thing: if you're doing that, you're really only trying to prove us wrong because your feelings are hurt. Yeah, that's my thinking. Like, I'm sorry we did okay. We're not here for the performance. I know Jerry's going to say this.
I mean, that's people have asked me before, like, what do my closing numbers and percentages and stuff.
It's just water, by the way. Water.
I honestly don't know because I don't track it that way. I don't really care.
I can attest to that. There's never a time I could ask Jerry, how's your performance going this year? He's like, I'm on the right side of the market.
That's the only thing I care about.
That's all he cares about. I didn't lose money, and I'm on the right side of the market. That has built your thesis.
Yep.
That is where his thesis has been since the day I met this man.
Yeah.
And once I understood what that meant, I bought into it because I was like, oh, this is a very simplistic, repeatable way to invest, to manage my retirement, right? I don't know how to do all the charts the way that Jerry does. I can do some of it, and I can do the minimum things, which is really all you need to apply this thesis of be in the market when it's going up.
Go in an uptrend, and don't be in it when it's going in a downtrend.
It is literally that simple. And again, full transparency, and I feel like it's bragging a little bit, but I'll do it for Jerry. These analysts that looked at that performance said, hey, kudos, because most people don't have the discipline to follow that thesis through. It's easy to say that, but you have to take the emotion out, like Jerry talks about all the time. This cannot be an emotional event. It has to be, did it cross the moving average? What was the RSI?
Yeah.
What's the MACD? Yep. That's a buy trigger. I should be in. A lot of people are, why aren't you in the G fund? I mean, why aren't you in the market right now? Because it's up 0.8%. Right. We got to rally.
Right.
All right. Simmer down.
Right. No, there was a question yesterday or today about if we had the Santa Claus rally, why
aren't we in?
Why aren't we in? And then another guy said, well, does that take away your theory about the F fund? And the bottom line for all that is nothing has changed, right? So we still, for the past year,
the
stocks and bonds.
trend hasn't changed.
The trend hasn't changed.
There's
Stocks and bonds.
Small things that have changed.
Sure. Yeah. Stocks and bonds went up and down together throughout 2022. And so far for the first week of January, they're still going up and down together. So as much as I've kind of been talking about this idea that, I'm sort of expecting a split, or it's not that I'm expecting it. The consensus view is that stocks go down because we have a recession the first half of the year. People flee to the safety of the bonds. Therefore, the F fund goes up, stock funds go down. That's the thesis. And until, how do we know when to, if that's what you think, then why aren't we getting in the F fund now? Because it hasn't happened yet.
Right. Somebody asked me that this morning explicitly. What do you think about, the market bonds? What? Yeah. And I was like, look, the consensus view is right now what Jerry explained. First half of the year, we might be looking at a rise in the bonds. And then the second half of the year, we might be looking at a rise in the rest of the market. Right. And if that plays out, great, you want to take advantage of it. I was like, because the first thing they said was, I'm going to go buy bonds. And I was like, no, that's not what I said. Right. That's not what I said. Right. I said you want to be watching that because it's a very unique time in history right now. Right. Bonds are the lowest in, was it 70 some years?
1780 something. It's ridiculous.
More than 70 years, sorry. 1770 years, whatever. I don't do math. We pay people to do that.
It's crazy.
But so why would you not look at that, right? If you are an active investor, why would you not look at that as an opportunity to go, well, that's very odd. So it's not normal. Mm-hmm. And so if I get an opportunity, first and foremost, if it's on an uptrend, a confirmed uptrend, then go do it. Like that's really what it comes down to, back to the simplicity of this methodology.
It's the same thing as saying like Tesla right now is getting absolutely clobbered, right?
Mm-hmm.
And so is Amazon and Microsoft, and I mean all of them. But Tesla is a good one because it's down 60-something%. I mean, it's down 16. I think Bloomberg this morning had it down 16% this week. And a lot of people, like last week, you could say Tesla's a phenomenal buy here, and now it's down 16%.
Yeah.
So was it a phenomenal buy last week? It depends what you think. If you think Tesla's going to be around forever and eventually it's going to turn back around and come back up, and you want a dollar cost average into it, maybe, or whatever.
If you're day trading on the fundamentals, go for it. But if you're looking day to day, week to week, you got to be doing what Jerry's doing, which is technical analysis, and you got to be doing it literally every minute the market is open, right? And so that's not what we do. Yeah. If I'm buying Tesla, it's because I think fundamentally they've got good management. Don't make me giggle right now. They got good management. They're price to earning ratios are good, like all those fundamental stuff, and it's strong for that's a whole different conversation. First of all, none of that has anything to do with managing a retirement account, which is what we're here to do, right? Like people ask me all the time about some company. I'm like, dude, first of all, I'm not even looking at them because we are more focused on managing, even in our personal life, right? Jerry and I put way more focus on building. This is the simplest version of building your own retirement. It's what the government gave us an ability to do with the TSP. It's what they did when they created 401ks, and IRAs to a certain extent. We've been giving this ability, which I wish that the contribution limits were way higher, but that's a whole other thing, right? If I want to give $100,000, then let me give $100,000. Yeah. But the point is, you've been given an ability to over time build a retirement nest egg and manage it. Most people don't manage it, right? So they put into it and they just expect it to get managed somehow, and they learn that it doesn't get that way. So what we are saying, what we're kind of advocating for is save for your retirement. We're building a whole nother retirement in our 50s, right? But why? Because we hope we live to our 80s or 90s, right? And so if you spend 10 or 15, 20 years building another retirement in something like a 401k, an IRA, or TSP, you guys see the point, right? That is our focus. We are not
trading Tesla.
Maybe on the side for fun.
Yeah.
I'm not putting $100,000 in Tesla.
Right.
And I'm not saying there's anything wrong with that, but we're not watching an individual company or a stock or an asset class. Yes. We're looking at a whole range of things, but why? Because that's how you manage a retirement account. You do not manage a retirement account by worrying about Tesla.
Yeah.
You can't. I don't care if it's outside the TSP. You can't do that in a 401k or an IRA. So we got to get off our soapbox and get the show going. But I mean, for people, I hope that this helps people that are new to us. You come by and you're like, what are these guys all about? Yeah. I'll tell you what we're not about. Sitting here debating whether you should buy Amazon or Tesla tomorrow.
Yeah, no.
That's not going to happen here.
That's not the thing.
All right, bro.
TSP podcast for the week, January 8th. So we're going to talk about a few different things. At the end, we're going to look at monthly charts. We never do that. Usually we look at weekly charts, but we're going to look at monthly kind of for a bigger perspective. So Santa Claus rally, we'll do a little wrap-up on that. And then technical versus fundamental versus statistical. Basically, we're just going to kind of talk through that. And the statistical piece, I want to kind of relate back here to Larry Williams. We're gonna go through his 2023 forecast a little bit. It's you guys can get it at ireallytrade.com. It's not inexpensive. It was a couple $100 for his annual forecast. It's probably worth doing. I'm just going to kind of go over some of the highlights, and then we'll do the TSP fun charts. All right, so Santa Claus rally, right? SCR. Santa Claus rally this year, well, the definition of the Santa Claus rally is the last 5 trading days of the year plus the first 2 trading days of the following year. So this year, that's the 23rd of December to the 4th of January. And over that time period, the S&P went up 0.80%. So we have a positive Santa Claus rally. Check. It's 1/3 of this thing they call the January barometer, okay? And it comes from Stock Traders Almanac. Yale Hirsch was the guy that created Stock Traders Almanac, and his son now took over the company. It's definitely worth taking a look at. Again, it's like a few $100 for the year for Stock Traders Almanac. But one of their kind of proprietary things or things that they coined was this idea of the January barometer, and it includes Santa Claus rally is one piece. The first 5 trading days of the year, which for us will end on January 9th, so next Monday, is the second piece, and then the third piece is the January closing price. So if all 3 of those pieces are positive, then the year tends to be positive by like 90%. So it's a pretty big deal. If the January barometer is positive, the odds are statistically high that, that year will be positive as well. So that's the only reason we really care about the Santa Claus rally, because if this is negative, then this whole thing is a no-go. So that's really the only importance of it's an indicator. The whole piece is an indicator. It's not a trading methodology or a trading tool. It's an indicator for what's going to happen, but later in the year. Okay. So basically 3 kinds of analysis that you can do, right? We do technical analysis. There's fundamental analysis and, like we said, statistical or like cyclical analysis. So technical analysis is basically the price and volume patterns, Elliott wave patterns, technical indicators we look at, relative strength, the MACD, CCI, you put Fibonacci's in there. They're all technical tools that we look at price movement. Fundamental analysis is all the things that go into individual companies. So earnings, employment fluctuations. It also goes to economic conditions. If input costs go up because we have, what's it called? We're in right now. We are not getting our stuff from China when we need to be. I can't believe I'm drawing a blank on that. But
Sorry, I wish I could help you. I was looking at something else.
Sorry. No, it's all these things that go.
I'm the guy taking the CFA test right now, and I could pop that over. I should
supply chain.
Supply chain.
So those are the kinds of things that fundamental analysts look at. And so CFA is a fundamental analyst, chartered financial. What does CFA stand for again?
Chartered financial analyst.
So they're looking at fundamental stuff. Chartered market technician is looking at technical price movement. And then kind of a third is this statistical cyclical analysis, right? You're looking at market phases. They talk about the springtime and the summertime and the fall and the winter of the market. And, kind of just like the weather patterns, the market tends to move in cycles that can be identified. Two of the more common ones is the decennial pattern and the presidential pattern. So, for example, we've talked about the decennial pattern quite a bit last year because the second year of every decennial pattern tends to be extremely bullish. That obviously didn't happen this year. The third year tends to be a follow-on of the second year. And that, if we have a follow-on of last year, we're going to continue lower. But, then the presidential pattern, the year that we're in right now, the year before an election, so the third year of the presidential cycle, tends to be extremely bullish for stocks. So if you're making your thesis based around some of these cyclicals, and you're not looking at fundamental or technical analysis, then your thesis of what should be happening this year can be much, much different than what these guys expect or these guys expect, right? Yep. And so that's why we're always talking about, like, we can listen to what different people say and put them in one of those three buckets, put the analyst in one of them three buckets, and expect that their analysis is going to be a certain way because it's
going to skew in one direction or the other
because of the bucket they're in.
That's the kind of analyst they are. Yeah, and I will say this is another thing that I think that you've done very well over the years, as you've kind of grown as an analyst. Probably has a lot to do with the fact that it's your day job now, and when it wasn't your day job, you're doing 12-hour work days in the government, and you barely got enough time to do this. But growing from just being able to have time to do the technical analysis to being able to add on these other things as sort of strength indicators, in a sense. I call them probability indicators, right? So, price and volume start there, right? And then you start growing. You got Fibonacci, you've got Elliott wave, all the things you do that kind of make it a stronger probability. Then, because you have a lot more time on your hands now to do this, right? You do a great job of kind of going into those other analytical biases, right? Statistical and fundamental, and say, okay, well, let's see what they're saying about this particular thing, and seeing how that plays into it. And what ends up happening is you're able to get a much more strategic probability. Right. And that's what I think a lot of people, when they're asking you a question, I see it going on in your eye. You're like, do you have an hour and a half?
Right.
Like, do you have an hour and a half for me to answer that question? Because it's not just, something I saw on Bloomberg yesterday. Like, it's literally like hours of research of saying, okay, like, let's test my thesis. Let's test the probability of this. Let's see what's going on in this area or this area, right? Those other two, let's bring that back up. Not just getting nailed. And so I don't know if this is where you're headed with this, but like the point is there's nothing wrong with taking in all of that.
Right.
Let's say, we know lots of folks who are way more fundamental, way more statistical.
Most people.
The majority of what you see publicly is that. And I will say this, the majority of what you don't see privately is very smart technical analysts, because they don't really care if you know that they're doing well. They don't. Yeah. If they're killing it, they don't care if you know at all, right? There's some hedge fund managers out there that really don't care if you know they're performing well, because they're performing well and it doesn't matter to anyone else, right? And so, I think you'll see a lot of people in those camps, I think in the last 10 years probably, are being way more receptive to technical analysis.
Yeah, at the end of the day, everybody uses it, whether you do it to the degree that we do or not. Nobody wants to buy something that they think is overvalued.
Right.
I don't know. At some level, everybody's kind of doing a price analysis to buy.
Anybody that I've talked to that is really, really a fundamental, biased person always admits that when it comes down to making the trade, they always look at the technicals. Right. They're never going to make it, like, if they do it for a living. Like, if they, this is not somebody in their basement. I'm talking about somebody that does it for a living, does it well, gets paid to do it, whatever. They say, of course I'm going to look at the technicals before I make a trade of a significant level, right? Especially if they're managing other people's money.
Right.
They're going to look at the technicals. I think the difference is, from our kind of methodology, your kind of system is to start there and go out. Whereas most people start in fundamental or statistical, and then eventually get over here.
Right.
You start at the chart.
Yeah.
Start at the chart and move out.
Yeah.
And so that's your methodology, right?
Yeah, it's just different. Okay, so let's get into Larry Williams a little bit. ireallytrade.com is a site.
That's a great name, by the way.
Yeah, it's pretty good. And he is, he doesn't have too much out on YouTube, but his stuff is really good. He did just put out a public version of the kind of the paid forecast, and it's pretty interesting. I can't remember if I already have it scheduled for to post to Facebook and all that or not. But if I don't, I'll put it up there. Because strangely, he does he's not quite as bullish as he was in the forecast that he did a little bit earlier in the year. At any rate, these are some of the highlights. So he's expecting this thing he's calling a kick-up rally to begin in 2023. So the chart we're going to show here in a second shows the Dow Jones Industrial Average with what is the most compelling, consistent cycle I have uncovered. So he's saying this is the most consistent and compelling cycle that he's uncovered. Okay. Black arrow marks the point where the kick-up rally rallies have begun in the past. This rally begins at the start of 2023. So before I go to the next paragraph, this is what it is, right? So this is the Dow Jones Industrial Average. It's not the S&P 500, but this is the important part. The red line, and all the way through all these charts we're gonna look at. The red line is the cyclical line. It's not necessarily the direction of trend. It's more of a timing tool. So you can kind of see it when the cyclical piece corresponds to a top, the bottom corresponds to a low, right? It's not exact, but it kind of follows the highs and lows. So what he's saying basically is if you just have the cyclical line, then this time of the year is a time that you would think about taking profits if you had bought it back here, right? So if you're trading TSP, let's say, the C fund, and this was 2021 to, can you even read that? Yeah, this is the beginning of 21, so here's the beginning of 22. So, he's saying we have a relative high here at the beginning of 22, which we did. And he's not saying this. This is the cyclical pattern. So it comes down to the summer, which it did. We had that summer rally, which we did, and it comes down into an October low, which is what happened, right? Then we had this run-up that we had at the last part of the year, and here's where we are kind of right now. And the cycle pattern calls for a bigger move going into the beginning of the year. And like he's saying, the last time this pattern, or all the other times this pattern has come into play, at the point where we are right now, it's been up 85% of the time. Okay, it's statistical. So it doesn't mean it's going to happen this year.
It doesn't mean an 85% increase. It means it's been an uptrend 85% of the time.
Right.
Because I was reading that the other way, and I was like, really? I got to go back and look at that.
Yeah.
No, it just means 85% of the time it's going to be on an uptrend.
Right.
Not necessarily that steep.
Right. No. This is only a timing tool. So the top. This is a time where you want to think about lightening up if you own stocks.
Mm-hmm.
This is a time where you want to look at buying. But in this case, it was basically flat. Mm-hmm. There was no down move in the stock market. It's just that on a cyclical basis, this is basically the date that you want to start lightening up. This is the date you want to think about adding to your position. But it's only one tool. Right?
Yeah.
Okay.
It'd be hard to only use this, nothing else.
Yeah, I mean, he wouldn't recommend it. So, chart one's more than just a cycle. It's a pattern of cycles. More importantly, are the legs of the cycle. So the arrow marks off the second leg of this pattern. So this was the second leg begins the second leg of this pattern. This has been a consistent time for stock market rallies. Since 1900, prices have rallied 85% of the time at this time or phase of the cycle, of the pattern. Okay, that's where that 85% comes from. Since 1900, prices have rallied 85% of the time at this time or phase of the pattern. Okay, so from this point right here, the beginning of the year, back to 1900, 85% of the time, the pattern has gone up. Okay, that is 1,000% at odds with all the fundamental data and macroeconomic stuff and everything else that's going on in the world right now.
But he's just, he's showing you statistically what has happened.
That's right.
And so one of the dangers here is that someone sees that chart and thinks, I'm in, I'm going in.
Right.
The difference between that and what we do is we have to wait to see if it does. We confirm the trend. We're not guessing. So if you bought right now, if you jumped in right now, you'd be buying a lottery ticket.
Yes.
That's all you're doing. You got an 85%
you get an 85% chance of winning.
Well, 85% based on statistics.
Yes.
Not on anything else, right? And so,
right.
Again, you'd only be using that data to make a rather large decision, right? So not a good idea. So I just want to put that disclaimer in there that if people think that's what we said, no, because I could see someone after this, they watch this show going, well, then why aren't we in?
Right.
Well,
that's right.
It's one data point.
Right.
It's one data point, which means if a lot of other things line up,
then we would get in.
Then we'll be ready to get in.
Right. True.
Right. Because that's what I watch. I observe what you do, and I see that's when I get a call that says, hey, might be having an alert.
Yep.
Might be having an alert because all these things are lining up. We're still not going to do it until it gets confirmed. Right. Confirmed the uptrend, back in. That's why we're never going to hit the bottom.
Right.
I mean, we're never going to catch the bottom.
Right.
It's impossible. That's a crystal ball.
Right. No, it's impossible the way we do it, the top or the bottom. Okay. So this is another kind of version of that kick-up cycle that goes through 2023. Okay. So here we are at the beginning of 23. And these are the dates that he thinks are going to be significant going forward throughout the year. So the idea is that we get this first rally into March. That's a time to, if you're in the stock market, that's a time to think about taking money off the table. Whether or not the market goes up, if we get to this point in the beginning of March, that's likely to be a high. Like, he's not saying this is what the stock market is going to do. This is just the cyclical pattern. So let's say the market goes down into March and we get a little bit of a rally, end of February, beginning of March. That's likely to be short-lived because now we got a section here which is flat to down, and then we get another rally time period. All this is time periods. So I hesitated really to put this one up because people think that if you look at it, you think, okay, here's May, the market's going to go up until May and then come down, which is actually the exact opposite of what the vast majority of the consensus is for this year. Okay, so I'm really the point of this whole thing is going to be to show that very smart people can be 180 degrees out on what they think is going to happen going forward, what a forecast is. Right,
and it's biased based on, or I wouldn't say biased, I would say it's skewed towards whatever their analytical tool is.
Right,
right.
That's right.
If you go to one of these three types of analysts that are just hardcore at that, that's what you're going to expect.
Yep.
Now, what a smart investor would do is to listen to all three.
Yep.
Right?
I would say so.
That and what that does is it doesn't tell you what to do, but it tells you what to be prepared for.
Right.
Right?
Right. That actually, let me throw this one in there about that. I had some people asking within the last couple of weeks about mutual fund window and what am I doing in the mutual fund window? I'm going to put out on the newsletter. That's what the newsletter is going to be about this weekend. I have, for the past few weeks, we've talked about the F fund quite a bit and how important that potentially could be in the first half of the year. And if stocks do go down, is there a way we can take advantage of that in the mutual fund window? Can we do better than the F fund? Answer is yes. If the stock market goes down, interest rates go down, long-term bonds go up. F fund isn't a long-term bond fund, but you can get a long-term bond fund in the mutual fund window. So basically what I'm going to do is lay out the funds that I'm looking at within the mutual fund window. If if this happens, then buy this fund. If this happens, buy that fund, kind of thing.
Yeah.
So anyway.
And it's only available if you remember.
Yeah.
So sorry, guys.
Okay.
Or sorry if you're not a member.
If you're not a member, you should be. All right. So,
but we're biased.
On this one, he's got the same chart, right? But it's back to 2019. It's the multi-cycle pattern. And this is the last time that this particular pattern right here, the last time that pattern showed up was 2019. And this is what happened on the Dow Jones Industrial Average, the black line, what actually happened in 2019. Okay, so this is kind of how you would use this. We had a low down here in 2019, which was put in a low also in the cyclical pattern. The pattern goes up, price goes up and follows it. The pattern tops out, the cyclical tops out here. It was a top, right? Then we had this churning in here. And it was forecasted in the cyclical pattern. Then we have another run up, which we did. And cycles move down. So he's saying this is a time where you want to get out of the stock funds. And the market came down, right? Came down to here. The tendency back up here. Down, back up. Now this did not correspond to the price move. Okay? So it's not 100%. I mean, none of the stuff is 100%. But there's certainly some correlation between using this as a timing tool. Okay, so this is probably the most important chart to kind of sort of get your mind around, I guess, because he's saying chart 19 is the roadmap I will be following for the major stock market averages in 2023. So I don't know how much stronger he can put that out in terms of his bucket, which is, statistical and cycle analysis. This is the roadmap that I'll be following for the major stock market averages in 2023. So this is the purple line is the trend. Okay, this is the expected actual price trend. This is the cyclical again, right? So from a timing perspective, relatively short term because of all the volatility in this red line. But he's expecting, this being the pattern that price generally follows, and this being generally a place to take profits, a time to get back into the market, take profits, get back in, right? So this is a good chart to kind of keep in the back of your mind. And the way I expect to use it is as price continues forward. So here we are in 23. He's expecting price to keep moving higher. If it does, great. It doesn't really matter. He's saying back here, this is basically the October low or December. So he's calling for the cycles are saying price moves up into December. The trend also moves up into December. We'll see. So what he's saying here is the trend moves up for the first few months. The cycles are also moving up for the first few months. Once we get to here where the trend starts rolling over and the cyclicals are rolling over, you're fighting against the cycles if you are in the stock funds during this time, right? And if you're not in it during this time, you're fighting against the cyclicals. So it's a roadmap. That's all it is. It's not a crystal ball. It's basically a roadmap. All right. Hopefully that gave you guys some kind of ideas about cycles and how you can put the blinders on and just be in this one statistical cycle bucket and entertain the possibility that the market can move higher into 2023 in the first half of the year. That's really all it is for me, because everything else I hear is negative for the first half of the year. But Larry Williams and Stock Traders Almanac are both bullish for the first half of the year. All right, TSP Fund Charts. Like I said, we're going to do the monthly charts this week just because to give us a little bit of a broader perspective. The trends happen, the minute to minute turns into the hour to hour and the day to day and week and then the month. And so we can see different things. So this is a 10-year chart, right? We're going back to 2013. What we have in December, okay. So we had a 2-month rally off the October low. And then December, we have an engulfing candle pattern. So the top tick in December was a little bit higher than the November high, and the closing in December was lower than the November low, right? That's generally not a good thing. You can see basically anytime you have that, hang on one second. Here's my eraser. Anytime we have that engulfing pattern, we had that at the top. We had it. You can see it quite a bit in here, and when it happens, it's bearish. You definitely don't want, especially in a monthly candle, you don't want to engulf the previous month's gains. It's definitely not a bullish. It's bearish. So, from the technical perspective, we're looking at the market to come down here and test that 3,500 low. You also have RSI where we're hanging out around that 50 line, not dipping too far below it, not dipping too far above it, but we got MACD that has clearly crossed down back here at the beginning of the year in 2022, starting to level off a little bit, but still has a long way to go to turn positive. So that's the monthly view going back 10 years, right? I mean, there's some other things you could look at. You could say, well, you have some pretty good churning in here, so that could provide some support there at about 3,250. You got the top before COVID, which is roughly in the same area, say 3,250. After that, you don't have anything until the COVID low. So I don't know anybody. I don't know too many analysts that are calling for anything lower than the COVID low. You never know, but those are kind of on a monthly basis what we're looking at. So if we drill down to a weekly, this is a 5-year weekly chart. So now each one of these ticks is a week. Each one of these ticks is a week instead of a month. And we have the 20-week moving average line in blue, and we still have the RSI and MACD, right? So the 20-week moving average line, you have overshoots all the time, right? We have these overshoots. But for the most part, when price is above that 20-week moving average line, it's moving higher, right? When it's below, again, we have overshoots on the upside. But when it's below that 20-week moving average line, price is moving down. And it gets supported by that 50 line on RSI and MACD here. So this is a weekly chart. We're below 50 on the RSI. MACD hasn't crossed over, to the downside yet, but the histogram is declining and it doesn't look good. So there's really nothing about this chart on a weekly basis, from a technical analysis perspective, that should make you think that any day now the stocks are going to start ripping higher. If you connected these tops and the market exploded up here and closed up here at 4,200, oh yeah, then that's a completely different looking picture, right? But we are nowhere near that. You have to respect the trend, and right now the trend is a lower high, lower low, lower high, lower low. This gave us a possibility, right? But it was really the first kind of correction to this first move down. And so now we have a lower low, a lower high, and we're in the middle right now in no man's land. Now, if we got a higher high, like I said, up here at like 4,200, then we would have a higher high to this and a higher low. Now we have a confirmed change in the trend.
That's a whole different thing. And that one little piece right there answers the questions for anybody that's been asking us, like, well, why aren't we back in the stock funds? That rewind it, watch that again, because that is the key. Like, we're not going to go against the trend.
Right. The trend is down.
Yeah.
I mean, there's no doubt about it. Yeah. When it changes, and it will change, right. It just hasn't changed yet.
We don't look at it based on the fact that it's finished for the week up 0.8%. That's great. Like, we're happy for that.
Sure.
But let's keep watching where the trend is going. We follow the trend.
Yeah.
And that trend isn't daily.
No.
By the way,
not in TSP. You get two moves a month. It's brutal.
Yeah.
All right, and then so that's the weekly. If you drill that down into the daily, which is what I do on the newsletters, now the blue line is a 20-day moving average. Okay, so the daily chart looks just like the weekly, looks just like the monthly. They act the same. It's just dependent on how frequently you want to trade or reallocate within your TSP fund. So in this case, the C fund, once it broke below that 20-day moving average line back here, it's been flat, but it can't get back above that 20-day moving average line. So, and it's been, for the last 2 or 3 weeks, it's been in this sideways pattern, and it's hung out below the whole time, below that 50 line. MACD is starting to turn back up, right? So is it possible that price moves higher from here? MACD crosses up, RSI moves back up? Yeah, it's possible. What's more probable is that you have a one leg down, a consolidation, and another leg down, where this leg and this leg is the same length to begin with, and that tests our 3,500 low. So that's my expectation. But again, if we got up here above that 20-day moving average line, and RSI above 50 and MACD cross positive, it's a buy trigger on a daily basis. Okay. So S fund monthly, it's worse than the C fund. Huge bearish engulfing candle. We get quite a bit of support there at 1,500. It's, crystal clear. You got 1, 2, 3, 4, 5 weeks. Months. I forgot these are all months. You have a long time we've been hanging out there at that 1,500 level. And it's pretty consistent with all of this back in here. So there's a lot of support there. If it fails, it's likely to come much lower. Does it have to fail? No. Everything in the consensus fundamental camp is saying that it's going to fail. But until it happens, we won't know. If I'm in the S fund right now, I'm selling it for sure below 1,500. And I'm buying it probably for sure at about 1,750. Because if it got up to 1,750, all these things would change. But below 1,500, it's in trouble. If it gets below 1,500, it's in trouble on a monthly basis. Monthly on the I fund, right? Huge rally last month, November, in the I fund, but we didn't get above 50 RSI even with that huge price move, and MACD didn't come close to crossing positive. So there's not a lot of conviction behind that move, even though price went up a lot, right? On this month, we're in a much different place, right? That's why the tools down here, technical indicators are really, really important, because if you compare, this price move looks a lot like that price move, but the technicals are in a completely different place. You really want to see MACD turn positive and start moving higher right before you take off, and that's what we saw there. And then RSI got above 50 and we're good. This RSI is in an uptrend when this happens. This RSI is in a downtrend when this happens. I didn't like sitting there watching the I fund go up either, but I wasn't buying into something that didn't have any conviction in it. F fund. The thesis that we've been talking about is that the F fund is going to explode higher as the stock funds explode lower. Looking at that monthly chart, there's nothing to indicate that that's going to happen anytime soon. So it's not my thesis that it's the consensus view in the mainstream media that that's what's going to happen. It's not me. And when I'm listening to the fundamental bucket, when I'm saying the consensus media, then I put on my technical analysis bucket hat and I look at this and I'm like, the F fund did this giant reversal monthly candle, and RSI is horrible, and MACD is still accelerating to the downside. Why does anybody think that the F fund is going to move higher anytime soon? So what, at the end of the day, what all this is telling me is we're going to have at least a continuation. I'm not going to say a repeat, but a continuation of the 60-40 portfolio failing. Stocks and bonds come down together, and you know, the Fed keeps raising rates. Maybe something breaks, and then things change. But for right now, there is no change in the trend from 2022. That's all I got.
I always wait for that slide. Questions.
Yeah.
If you have any questions, you can put them in the comment section wherever you find this video. If there's no comment section, you can always email us at support@growmytsp.com, and the nice folks in our customer service department will send it over to us.
It will indeed.
If it's anything personal about your, personal investment advice or whatever, probably not going to do it. It's not what we do. But if you have questions about the charts or some things you'd like to see on the show, more importantly, that's where we get a lot of great ideas. You guys send us questions about things. It pokes us, and we're like, oh, okay. Well, if you've got that question, then there's probably a lot more people.
So somebody put up a question on Facebook about taking out TSP loans. So I think next weekend's show we're going to talk about that. There's, it's another one of those things that are as true as gravity. Everybody will tell you, do not take a loan against your TSP.
Right. Because it's your money. But it's all these things. I mean, I think this will come out in the next show, but really it comes down to your personal circumstances.
100%.
So best thing to do is sit down with a financial planner and see if it's the best option you have. Right. Because there's the worst options and there's the best options. Sometimes it is what it is. You need the money to do something, and this is the best of the worst options. Right. And so to say never, 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 never is, I see that stuff too, and honestly, I just ignore it because I'm like, you have absolutely no idea what that person's personal circumstances are, and you're telling them it's stupid to take out a loan on your TSP. I don't think I ever did. I don't remember, but I'll have to go back and look. If I did, it was early on in my career, which again, when you're younger and you're in there, you don't think about these things and how they impact your retirement account. But hey, it's all personal circumstances. But that would be a good one because most people are confused about. I saw one question that did make me think about it, like, oh, what do you if you have a loan and you retire and all that kind of stuff. So that might be a good one. So if you have questions or comments or things like that, don't hesitate to send it to us. It doesn't have to be through email. You can pop us on comment section on YouTube or Facebook. Sometimes that takes us a little longer to get to see it, but we do go look at them. So hope you guys are having a good start to the year. So far, so good, here, knock on wood. So hope you guys are having a good year, and stay tuned because it's going to be a wild ride this year.
It's going to be a ride. It is.
Yeah. All right, guys, have a great week, and we will see you later. Cue music.